Hey traders, Nick Shaheen here looking at the XLK, which is the technology sector, basically one of the ETFs that tracks it, trackers. So SMH is another one for semis, for example. So yesterday we all know what happened on 625. There was a huge market drop, and especially the high flyers, which up until that point had been the high tech or tech stocks, momentum stocks, included like Netflix and company. Google fell hard. So it was indiscriminate selling, orderly though. So we had 2 or 3 bottoms during the day. So this is yesterday. This is a 5-minute chart, by the way. So today's point is how to manage a trade. First of all, how to identify the trade and take it, and then manage it the next day. So yesterday we went into the overnight session long, one of the two, SMH or XLK, depending on personal portfolios. And this morning we opened with a pop. So this is about this morning. Traded choppy. There were greens. Immediate, the P&L on the trade was positive if I bought calls, and then it dipped. So if I didn't know the levels, then I would have been tempted to be shaken out of my trade. So the point is, I have to study the levels and know what's going on in order to decide whether I get out, add, or change or adjust or sell calls to make a calendar. So somebody that doesn't track the levels would be tempted to, oh my gosh, they're following the ticks, and they have 7 or 8 ticks in a row that are red. Then they tend to, okay, this is going to be a redo of yesterday. They get out at exactly the wrong place. Why? Because if I had known that they got back to the place from which they broke out overnight, then I would be tempted to say, okay, so they broke out from a neckline. They're just revisiting the neckline to see if it's solid footing so they can continue on. There's also something else. There are statistics that say, that from here on out, you've already established about 90% chance that the range is set for the day. So what does that tell me? It tells me that a breach of the range in either direction should be followed. So that's the second piece of the puzzle. First, I know not to get out at the wrong spot. Then I know that the range is set, somewhere from here on out. And a breach of the range this way tend to carry, and this way tend to carry. So what happens is somebody that's following this will see, okay, this is positive momentum, and I stay long if it gets here and above, versus I have to book profits. Of course, from here on up becomes a lot harder work to be done. Depends on what happened before here. But these are pieces of the puzzle that make me say, okay, I get out if I see a breach of this. I stay long or add if I see a breach of that, in theory. So odds are, you increase the chances of this happening. So number one is I don't get shaken out by a few red ticks in a row. So I watch levels, not ticks. Number two, I know what happens when I have a plan. And also to that, I did extra homework and went to see what am I in? What's in this XLK? You can see that it's Apple heavy, Microsoft heavy, and third is Google heavy. No, not Facebook, because Google is 2 tickers, so it's 10%. And Google was the laggard, and it was red. So then I have to look at the Google price action and see what it was doing. So on one of my screens, I have to have Google while trading the other one, and you can see it almost mirrors the same price action. So I knew that as soon as I saw this cup and handle-ish, I knew that Google was headed for a new high of day, which it had struggled. See how it opened down and never recovered. It didn't recover as fast. So I have to see all pieces of the puzzle before I decide what I'm doing with my trade. So number one, don't get into a trade just because you hope for a bounce, because technically I saw that there could be a bounce. And number two is, once you get into a trade, I have to study the levels to see where I get out, where I chase, this way or that way, and what else is at play. So if the yen is rising and is causing the whole market to drop, or bond yields or bonds, the chase for bonds is still continuing from yesterday, and or in this case, what's Google doing, because that's the only laggard. Apple was rallying. So I had to look at all these before I get shaken out of the trade. So the bottom line is there are plenty of clues that I have to look at when I'm managing a trade. And one thing I don't do, I don't react to ticks. up or down. So up here, if I saw the stick and I wasn't long, I'd be tempted to like, oh, let's go because of this gap. But not really, because I was already long and I have to see if I should book or not. So this is how I trade. So then I added some IWM calls. So now I'm long technology, and I'm long something that's not so touchy-feely with the tariff thing, right? Because the perception is that IWM is somewhat centric in the US, therefore less sensitive to headlines for tariffs. But I was already long the Dow, so I bolted on the DIA because it's been a laggard because of the headline of the tariff, and I switched my longs into something that is not dependent on tariffs. So I am more fundamentally based versus headline based. So yes, the DIA would give me the best bang for the buck, but I didn't want to chance it. I'm long technology, which is already a momentum trade. I don't want to be long something that shouldn't be a momentum trade, but is because of tariffs. See how it all comes together? There are no darts. All right, so Nick signing out. If you have any questions, sellspreads@gmail.com.